Hello, everyone. On today's edition of The Final Bar, we're going to talk market distribution. Back and forth we go. A nice rally going into the close with stocks and bonds actually finishing about even. So we're going to talk about what that relationship means. Also, a real focus on income, the income side of the equation when you're investing in equities. My guest, David Auerbach, is going to help us understand the real estate markets, how that should relate to your overall asset allocation decision. So, ladies and gentlemen, this is The Final Bar. Hey everyone, welcome to today's show, The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close to debrief on the markets from a technical perspective, connect the short term to the long term. And now more than ever, it's all about trying to put each day's movements into proper perspective. I feel like each day right now is a learning experience. Earlier today, we had the circuit breakers on the S&P triggered again, or on the New York Stock Exchange with the market jumping down over 7%. And, again, each one of those different events, each one of these days hopefully provides some opportunity for clarity to understand what's happening, to get your head around it. But also, I've always found, again, having gone through a number of bull cycles and a number of bear cycles, while bull cycles feel good to your portfolio and your returns, I feel like I've grown the most as an investor during some of these bear market phases, because that's when you really start to see weaknesses in your toolkit, think about your routines, how you're approaching things, and all of that. So a lot of interesting themes I think we'll be able to touch on here today. Thinking about the schedule coming up, we actually have some great content coming up on Stock Charts TV and on this show. Tomorrow, my guest is Cliff Droke. He'll be joining us tomorrow on Thursday. On Monday, my guest today, David Auerbach, we're gonna feature a longer interview that we had with him at a recent money show down in Orlando on our sister show Behind the Charts. That's coming up this Monday. On Tuesday, my guest here on The Final Bar will be Rob Slimer from Fundstrat. And then on the 25th, we have Pat Suresna on this show. And also, we'll be doing a special event called Navigating a Bear Market, featuring myself, a number of my fellow Stock Charts contributors, all kind of bringing our expertise together, sharing with you little nuggets of wisdom, ideas of how to navigate this period. So I hope between all of those guests and that special coming up on the 25th, we'll give you a lot of good information, a lot of good things to review. We also, as we get to our market recap, I did want to point out we did a great poll recently talking about oil prices, and the question was whether or not you think oil prices are going to retest that 60 level, and what I would point out, thinking of the chart here, is the chart of oil. Oil has actually gone down significantly. We asked that question into last week, and the problem is the oil has come down significantly. So looking at the chart of oil here, hold on, going to intermarket analysis here, our oil price updated yet for the day, but if we look at the USO, you can see the jump down here. So the USO actually went down almost 20%, and actually during the day it was down all the way to 20%. 80% of you, by the way, 79% of you said no on that. Only 21% of you said yes. Gun to my head on which one I think, it's hard to disagree with the no's on this one, only because when you look at how much that has come down, will crude oil stabilize? Will it find support? For sure. Is there a chance it can get back above 60? There is a chance for anything. The fact that it would V-bottom and rebound up to those extremes, I would find extremely unlikely. Now, and again, all else being, or just to be fair, we asked that question during this sort of distributive period, not when it was really capitulating to the downside. So I bet if we asked that question every day, we would get more and more no's on that. But I think the chances of it getting back to 60, I would say highly unlikely at this point. And the challenge now is how many companies are tied to that, having oil back in this sort of range. A lot of, if you think about the long-term trend, we've been range bound for, a year, if not multiple years. And all of a sudden we're completely lower. So companies that built their business around oil at a certain price, which they all do. They have to make assumptions. It can be fairly difficult. So thanks for answering the question there. Again, always on the show, you'll see the survey going on the side. I'd encourage you to answer those questions as much as you can. We'll refer to them on a later show. In terms of what the S&P did today, getting back to the current markets, we actually finished down only 5%. And in this new world we're living in, that actually feels kind of tame relative to some of the other movements we had. If you can see on the short-term move there, that little horizontal line around 1 p.m. is the circuit breaker. When the market goes down 7%, we trigger that 15-minute halt on the New York Stock Exchange. That was sort of hold things stable. We reopened and went down even further, down to 8 or 9%. Then saw some stabilization. Now we have macro news, a lot of press conference, a lot of talks about stimulus. And again, it's all about reactions to expectations. It's all about the fear that's motivating investors, how that fear may or may not be alleviated based on what we're seeing. Looking at a chart of the S&P here, you can see that, we've talked about that 2350 level, that key line in the sand for stocks. And we went below it earlier in the day. As I'm making notes for the show, I'm thinking, okay, well, there goes yet another support level. We'll start to look a little longer term. Now, what we did was we actually trade back above that support level. So anytime we talk about a key support level, especially on a longer term chart, just trading through it is not enough, right? You want to close through it. And then I always talk about a confirmed breakdown or a confirmed breakout, which means you have some sort of follow through the next day. And Tom DeMark years ago sort of taught me the logic of waiting for some sort of follow through, because it just keeps you out of some of those whipsaws, some of those false signals. So at this point, I think 2350 still is now a very important level, has been, now that we've actually broken through it intraday more than ever. And again, we'd want to see a close below there before we can signal sort of a suggestion for further lows. In terms of the sector movements, it was pretty interesting. So it was certainly the defensive side of the markets doing the best. So consumer staples, number one, followed by comm services and healthcare. All of those were down 2.5 to 3.33%. So not bad, and much less than the overall market. Down the bottom, you had energy down the most. And again, oil prices really dropped significantly, followed by financials. And financials of any sector that seem very logical they'd be hurt by this environment. Financials certainly make sense, besides consumer and other themes that we've all talked about. Real estate, that we're going to focus on momentarily, down a little bit more than the market overall, but not too much further. Interesting to see small and mid caps remain down significantly. So if you look at the chart of the S&P, it recovered very nicely. So if you look at the short little preview, came out of the lows early afternoon and actually rebounded very nicely. Small caps actually just remained muted. So again, it's not sort of that all clear, everything's fine. These little intraday rallies, I think, are more about asset allocation. It's more about flying to safety. It's more about getting into some of those big defensive names, and not about stepping on the gas pedal and trying to go anywhere new. And I think that's what that means when you see small and mid caps so low. The VIX actually held steady around 75 to 76, which again is incredibly elevated relative to where it had been earlier in the day. It had gotten up all the way above 84, but back down to 76. But again, still on any measure, incredibly elevated levels. Let's look at some of the ETFs and some of the industries to just see what happened. So in terms of ETFs that were down the least, everything was down, but Japan, Italy holding up actually pretty well. Hong Kong, which has been in the news a lot, looking at the coronavirus issues, down 4.5% of the overall market. The big losers were markets tied to oil. So Brazil, Russia down 15% each, followed by Australia down 12%. Looking at industry group themes, there were 4 of the Dow industry groups that finished in the green. Telecommunications equipment, which is within the technology sector. Within consumer discretionary, you had broadline retailers. And again, could be interesting looking at some of those names. If you look at the last week, they've actually held up really well and starting to emerge to the upside. So it might be worth looking at that group and seeing if there are opportunities in there. Drug retailers also coming up for obvious reasons, I would think, related to battling the coronavirus. And then delivery services, which makes a ton of sense, because I don't know about you, but our household is driven by a lot of deliveries right about now. In terms of groups going down, you have a couple of real estate groups, also airlines, mortgage finance, transportation. These are ones that sort of make sense based on what's happening around here, but also pipelines. So again, a lot of the energy groups that are related to that are going to feel quite a bite if you're looking at potential downside here. In terms of individual names, again, we don't have time, unfortunately, to go through all of the stocks making new highs, new lows, or stocks making new movements. I would point out again that if you look at the top rated stocks within the scooter rankings, it's a lot of companies that are pretty much in the social distancing space, I guess. So things like Smuckers, which is a Northeast Ohio company. So I've followed that for years when we lived in Cleveland. Actually breaking above the 120 level the last couple of days, which is a pretty good move. Clorox, Eli Lilly, Kroger's, these are all sort of those disaster prep types of names that are going to benefit from that sort of thing, but also a healthy dose of biotech, Regeneron, Gilead, and some others in there. In terms of stocks appreciating the most in terms of their ratings, I thought it was interesting to see FedEx in here. FedEx is coming from a pretty low level. So again, you have to be cautious. I would never look at the stocks making new gains in their scooter rankings and think of that alone as a signal. A lot of those times they're coming from pretty low levels, and that's certainly the case with FedEx. But here you have a stock that's been underperforming, that's been oversold, coming out of the oversold region. Nice accumulation today with going above the previous day's high, retesting that 100 level, and that big round number level is where a lot of people sort of expect support and resistance. If it can get above 100, sort of social accumulation, that could be a really interesting stock coming out of a very beaten down level. And again, I think a lot of people obviously relying on something like FedEx, but up 5% when the market itself is down 5%. So worth looking at some of those stocks that have made improvements. That's all that time we have for our market recap. Again, I feel like on a 30-minute show, we just touch on all these things. I hope you use this as an inspiration to dig a little deeper on your own, maybe later tonight after the show. Look at some of these stocks that have gained in their scooter rankings, and also focus on the ones that have lost. Make sure you're owning more of the names on the left than ones on the right, and over time, you're going to be in a better position than otherwise. We need to move into our next segment, which is dialing up dividends. This is a new segment that I asked our producer to throw in there, because what I found is in this sort of environment, when you're thinking of income, I think the dividend component can be even more and more meaningful. There's an article in Barron's that I used as the inspiration for this. If you read Barron's last weekend, it was called 12 Safe Dividend Plays for a Dangerous Market. And again, this is before this week, which has been created even more pain. It was highlighting stocks that have a pretty good dividend component, that have paid a consistent dividend, and the yields were pretty good. And it focused on stocks with a dividend yield in sort of the 5 to 8% range. So I made a chart list of those stocks. We're going to go through them together very quickly. I will point out to you is on each one of these charts, if you look at the annual dividend and then the yield, which is in the full quote here at the top of each chart, you'll notice that the numbers have increased dramatically. So some of these staples names, some of these energy names, they're paying a dividend yield up in the 9, 10, 11% plus range, which means if you think of it as a savings account, which I would not, but if you just for a moment think of it as a savings account, you're getting paid 10%, 9, 10, 11% on your money just to invest in these beaten down stocks. So that's why it's a compelling option here. Let's look at the charts and see what these things have done. So we're looking at a weekly chart. I'm going back about 7 years just to bring in a good amount of history to show where some of these stocks have come from. They're just in the order that they appeared in the article, but what I like to do first is do a summary, and we can actually see where they're grouped by sector. So AT&T, which makes sense. And when I think of high dividend pairs, AT&T is sort of my go-to name that I tend to think of, but you'll notice a couple energy stocks were in there. Sort of the big, conglomerates, but also some others, the integrated oils. Down here, we have a couple in financials. These are insurance and a couple banks, things like Wells Fargo. AbbVie was actually an interesting one to pop in the list, but an interesting one as well. And then you've got a couple others, and only one staple stock that appeared in there, and that's Altria Group, ticker MO. So let's go through each one of these one by one. So starting with Altria Group, again, the challenge with a lot of the tobacco stocks is they had been nice charts, 2016, 2017, but look at how the price has just rolled over. And I think a textbook on a rotation from accumulation to distribution would include MO as maybe the perfect example of that. You have a Dow theory downtrend that's been going on for 3+ years, lower lows and lower highs. The relative strength is what's so important here, though. If you look at the relative strength, since that downtrend has happened, you think about what the rest of the market has done, and you realize why the relative strength has been so negative. But look, it's just starting to make a new 6-month relative high here. And, again, if we continue to hold up here, would certainly improve more and more on a relative basis, assuming this bear market phase has more to go in terms of time and or price. So the stock was down a little bit less than the market overall. It's in a downtrend, which I don't like, but I like the fact that on a relative basis, if it sort of stays with this overall gentle downtrend, it's actually a pretty compelling relative bet and paying an 8.5% dividend yield right here. Going quickly through the rest of these, only one in materials, that's Dow Holdings, ticker DOW. Now this article was written, back here as it's just jumping off a cliff. It's now paying a dividend yield, over 10% because the price has come so far down and it's almost been halved in the last couple of weeks. But again, if you're, at this point with some of these charts, I feel like you're betting it on either recovering and having some sort of, improvement in the business, or it's going to zero. And if that happens, obviously it's kind of a disaster. But if it's able to, remain solvent, you're getting in at a pretty good depressed level, and also with a good dividend component. Number of the energy stocks in here, Exxon and Chevron, both fit the bill here. What's interesting about something like ExxonMobil is it's extremely oversold with an RSI below 10, which is incredibly rare. It shows you how steep the sell-off has been. Again, I don't like the idea of the falling knife characteristic of these energy charts. So from a pure chart perspective, difficult to pull the trigger. But again, from a total return perspective, could be compelling. And if you're looking for bottom fishing candidates, you might not be worth, might be worth, thinking of some of those as opportunities. Again, just if these things can stabilize, you're getting in at an incredibly low level. You also notice the scooter rankings on these are pretty low. So also within energy, you have Valero with an RSI of 15, and again, relative, just absolutely getting killed, but an incredibly high dividend yield now. Prudential, so it's interesting to see just one financial in here is Prudential, and again, insurance carriers along with others have been hurt by this. Down even more than the market today. So this is down over almost 13% today. But again, the RSI really oversold, the relative strength really extremely low. But again, now paying a dividend almost 9%. Comerica, sorry, there was one other financial or two more maybe. So all of these really hurt. Now this one actually, Comerica testing long-term support from the low in 2016. Again, the relative strength is what frightens me about those. What's interesting about AT&T here now is as you see some of those other charts that are so beaten down, they have a high yield because the price has come down so much. AT&T pays a dividend yield of only 6.25%, which on an average day is actually pretty decent compared to some of these beaten down stocks. It feels pretty low, but it's actually well above the average for the S&P. This is a stock where the RSI has remained above 30. It hasn't become oversold. And look at the relative strength. This is actually sold off much less than the rest of the market. So it's actually a 2-year relative high right now. We move very quickly through the rest of these. We have Chevron, we have Wells Fargo, which scares me, these financial stocks, but again, a dividend yield above 7%. Now, AbbVie is the only healthcare stock in here. It's interesting to see a biotech paying a good dividend. It's almost the best of both worlds, a stock that would benefit from the upside in healthcare, upside in biotechs, but also with a good component there. And again, only one technology stock that fit it, Seagate Technology, which is testing its 200-day moving average, 150-week moving average. It's a much longer-term moving average, so could be of interest. So that's a quick rundown through the names that, again, in a Barron's article last weekend, talking about dividend plays, 12 dividend plays. I thought it was interesting to note how high those dividend yields have been with these stocks have been beaten down. But it also shows me a stock like AT&T, which holds up on a technical basis with a good dividend component. That's an area where I potentially want to be considering for potential long positions. We need to be back with my next guest, David Auerbach. We'll see you in a minute. Hey everyone, welcome back to our show, The Final Bar. I want to thank you so much for all the questions you've been sending in, also the feedback on the show. This is a time where we feel we can help you as much as possible. So questions on anything, on the markets, on the structure, on specific charts, indicators, just get them to us at thefinalbar@stockcharts.com. We're going to have another mailbag segment later this week, and I'd love to answer your questions during that segment. Want to bring on our next guest, though, David Auerbach. David is an institutional trader with World Equity Group. He's also the editor and contributor to the daily REITBeat newsletter. We had a chance to interview him at the Money Show in Orlando, and I asked if he would come on the show and share his take on the real estate market. So, David, thank you so much for joining us today. Really appreciate it.
David, thanks for having me. I really appreciate it.
So you sent a couple of tickers ahead of time, which I've brought up here within the REIT space. I'd love to just hear your take on things and start going. I'll move the visuals along over here.
Sure. So as you know, we're in, as you've mentioned, a new normal, a new environment that we're operating in, and REITs have been a great level for income and safety. Granted, right now in the in the world of Wall Street, nothing seems safe. But when you look at the dividend structure of REITs, with the way that they are trading versus the 10-year bond right now, REITs are a very attractive sector for long-term investors. And you have a chart up right now of the Pacer Benchmark Industrial REIT ETF, ticker INDS. This is a very interesting company, a very interesting ETF, as it comprises many of the industrial REITs that house Amazon as one of its largest tenants. And as talking about all the stuff today with coronavirus and quarantine and everything, one of the companies that has done very well in this environment right now is Amazon. And so this is a unique play to try to capitalize on the growth of Amazon and online merchants. So INDS was formed by Pacer Benchmark. It's been out for a couple of years. Granted, it has sold off over the past couple of weeks, but if more and more business goes online, Amazon will stand to benefit. The industrial REITs should benefit in the long run, and INDS might be a good avenue to play that. Another idea is the other chart that you have up there is Server, SRVR. This is their data and infrastructure REIT ETF. This is comprised of tower REITs and data center REITs. And again, thinking about how everybody is quarantined and living life online, the uses of cell phones, using of data centers, Server would be another interesting way to play this particular space. The third ETF I sent you was NetL. That is the Fundamental Income Net Lease REIT ETF. Net Lease, if you think about shopping centers and malls, there's these out parcels or a lot of properties that are triple net lease to gyms and drugstores and fast food restaurants and gas stations, just an example. And so the guys at Fundamental Income came from a company called Store Capital, ticker STOR, that was that is owned a large portion of it by Berkshire Hathaway. And net lease REITs have very long-term leases in place, 20-year type of relationships. And Realty Income, letter O, WP Carey, ticker WPC, have been around for, they're the two largest holdings of this particular ETF. You know, they've weathered a lot of these storms in the past. The REIT environment is much different than what we saw in 2008, 2009, as these guys have stronger balance sheets, diversified tenant bases. And so as a result, net lease should be, in the long run, a very interesting sector to follow just based on the long-term lease structures of these companies. So yes, the headlines look pretty ugly right now, but over the long term, REITs consistently pay higher dividends than a lot of their Wall Street brethren. And so for older investors, those that are seeking income and safety, REITs are usually a good avenue to go and pursue.
Those are three interesting stories there, David. I'm bringing up just the chart of the real estate sector ETF IYR, and just one quick question, if I could, to wrap it up. How do you think about, or how should investors think about, this sector related to some of the others? I mean, you talked about providing a good income component, but if you're an asset allocator, if you're trying to think about where you're at right now, given the sell-off in equities, what do you do now if you're looking at real estate? Is this something you should be increasing, decreasing, and how do you think about it related to the other sectors?
I was always taught, if you don't know what to do nothing, is first of all. I think it's those that are like on a risk reward play. REITs have usually been a very riskless type of industry just because of the structure of the companies. Remember that 95% of the income is paid out as dividends to shareholders. And so thus it's a very attractive industry to be in. My 2 cents, me personally, I think we are going to work our way out of this coronavirus issue. I think, you're seeing some of these stocks that are trading at such deep discounts that eventually they are going to come back. As an example, Bill Ackman was on CNBC today talking about Park Hotels, which is a REIT spun off by Hilton, ticker PK. The stock has gone from $33 to $4. Why? Because they think that the hotels are going to be going to zero. So, granted, yes, the stock has taken a dramatic hit, but if you look back just a couple of weeks ago, again, the stock was trading in the mid 30s. And so this could eventually come back in time. I feel like at some point, some of these guys are worthy of, tiptoeing in very cautiously, but that's a question that has to be answered by each individual investor. From where I sit, seeing what the REITs did in 08, 09, or after 9/11, that there were guys that bought some of these companies at such deep discounts. And I feel like many investors are going to look back, hopefully, a year or two from now and say, boy, the trading that we did in March of 2020 was the trade of the century.
David, that's such a great take. Thank you so much for joining us on the show. Thanks for sharing your perspective on the market environment, particularly with the real estate space. Have a great day. Be safe, all right?
Thanks, Dave. Appreciate you guys.
That was David Auerbach. He's the editor and contributor to the daily REITBeat, also an institutional trader for the World Equity Group. So fantastic take on real estate. How a lot of, and again, I've found so many investors are not familiar enough with some of these opportunities that are around there. If you really think about all the different levers you can pull as an investor. We folks need to wrap up today's show by going right to the 3 in 3. So at the end of every show, 3 charts in 3 minutes. If these are not on your radar yet, they should be from here on out. So number one, the TLT. We talked about bonds just briefly earlier, and I tell you what's interesting right now, and the reason why this is one of the 3 in 3 is when stocks are down so significantly over the last couple of days, you would very logically and probably reasonably think a flight to safety probably would mean bonds are actually holding up pretty well. What you'll find on the chart is actually it's not been the case. Stocks and bonds actually both were down about 5% today. Bonds had sort of a slower and steadier decline while stocks sold off more significantly and rebounded. But in the end, they both ended up beaten down at the same time. So most asset classes, if not pretty much everything, was down today. It was a flight away from a little of everything. And again, there's again a lot of macro themes in here. This is related to stimulus packages and how much that's actually going to be able to support some of these markets. But if you look at the prices, you're finding distribution in bonds, not accumulation that I would maybe expect here. Chart number 2 is looking at the yield on stocks versus the yield on bonds. There's a couple different ways you can do this, but I like to look at the difference between the yield on the S&P 500 and the yield on the 10-year. So basically, if you bought bonds or you bought the S&P, what's your yield on one versus the other? You can see that the yield on the S&P has been going up as the price has been going down. The yield on the 10-year overall still around 1%, which is way below what it's been. And that means this ratio is almost at an all-time high. We're at the same levels we were at the 09 level. And this is using the S&P. If you think of something like real estate or some of the dividend stocks we looked at, the yields are much, much higher. So certainly suggesting there are income opportunities within the equity environment. Third is looking at the GLD, looking at gold. Again, you'd expect this to be a safe haven. I was talking with Tim Tashler on the show yesterday about looking at gold as an opportunity. But what we're finding here is the chart has actually been coming down pretty aggressively over the last week or two. It's holding steady at the 200-day moving average. And I think that's why it's such an important chart right here. If we can hold that level, I think that's pretty key. We're also testing the lows from last November and December. That's just about where we were a couple days ago. So if we can hold that 136 level, 137, that's sort of the support from back here, the support from last week. On a relative basis, though, it has held up so much better than stock. So as an asset allocation decision, staying in something like gold, I think can make plenty of sense as a potential cushion for the downside, along with some of those dividend income-related stocks that we talked about. Ladies and gentlemen, that's our show for today. I want to thank you all so much for hanging with us as we figure out how to produce all these shows, given a lot of us working remotely. But thank you so much for watching. Would love to answer your questions on this show later this week. So just shoot us an email, thefinalbar@stockcharts.com. I want to give a special thanks to my guest, David Auerbach, from the REITBeat newsletter for joining us, sharing his perspective today. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great day.